Yo, my people, I welcome all of you once again to my channel. If this is your first time watching my video, consider subscribing because on this channel I have so much to share with you. Yes, in my previous video I talked about how to locate demand and supply levels in the markets, and I walk you through the various lows and highs, talking about yearly lows and highs, monthly lows and highs, weekly lows and highs, daily lows and highs, and sessions lows and highs. Now, in this video, I'm going to talk about types of demand and supply structures. Yes, we have structures for demand and supply. Yes, in other words, you can say demand and supply market structures. So before I delve into the main topic why we are here, I would like to walk you through few tips, which are: price always oscillates to fill and fill buy and sell orders which are being created by institutions. So anytime you see price movements in the markets, it is an indication that price is going to fill imbalances or buy and sell orders being created by institutions. And then also demand zones are created by when there are more buy orders at a given price, and also supply zones are also created by when there are more sell orders at a given price. One thing you must take into consideration is levels of unfilled orders act as magnet for price, because price has to come back to those levels and fill it before their transactions could be completed. So in a nutshell, demand simply means unfilled buy orders, and supply simply means unfilled sell orders. Market moves based on demand and supply, but not based on indicators. Yes, now we are going to look at the various types of demand and supply structures you have. Yes, talking about demand zone market structures, there are three levels involved, or three concepts involved. The first concept has to do with rally. Rally means an uptrend or a swing high or buy pressure. And the second concept, so far as demand zone market structures are concerned, is base. Therefore, there are two concepts we are going to deploy in determining our demand zone market structures. It is a trading period where buy orders are matched with sell orders, or where there is an equilibrium in the markets, or consolidation. Yes, or we can also say where there is a range in market structure. So I'm going to illustrate it for you to see how it looks like. Yeah, this is a typical illustration of demand zone market structure. So I'm going to name the various parts so that it will become more clearer to you. Yo, my people. So this is a typical illustration of demand zone market structure. Observing the lower side of it, this is a rally, which is an uptrend or buying pressure. Yeah, so this represents bullish or an uptrend move. And then the top here, which is a base, represent consolidation. Have you seen? This is a consolidation or equilibrium or range movement. And then aside that, the base is our demand zone. Yes. And then typically we have two types of demand zone structure. So I'm going to draw the second demand zone structure for you to see. Yeah, looking at the second type of demand zone market structure, this one is no more rally. This is a down move. Mini price is heading downwards from the top. So this is what swing low or down move, which is normally called drop. So D stands for drop. And then down here we have our base consolidation or equilibrium level, which is our demand level. Yes, at our extreme right side of the market is our uptrend or up move, which is technically called rally. Yes, so in short, this type of market is technically called drop based rally, meaning markets make a swing low, consolidate, then makes a swing high. There are two zones where demand could be located. In the first case study, demand is located at the middle of the trend. As you see, rally, base, rally. So in other words, uptrend, demand, uptrend. So this particular demand market structure is what where demand is located at the minor levels in the market as compared to the second case study where we have down move, consolidation, up move, technically drop, base, rally, where our demand is located at the extremes of the demand curve, or it is located at the major demand zones. Yes, so the first one we technically call it rally base rally, or for short RBR, uptrend demand uptrend, where demand is located at the minor levels as compared to the second case study where we have demands being located at the major levels. Yeah, so my people, these are the two major types of demand zones market structures. Now I'll take you to the chart and then help you locate these two types of demand levels. Yeah, this is a typical case study of rally based rallying. As you can see, this particular up move is our rally, and then we have our base, which is consolidation, also serve as demand zone. After that, then we have another up move, which is what rally. So we have rally, base, rally, or swing high, demand, swing high. Yeah, so let's look at more case study. Typical rally based rally happened. As you can see, this momentum bullish candle, which was caused by institutional activities or high impact news. So this very momentum swing high candlestick formation is our rally or swing high or high buy pressure. Then we have our base, which represents consolidation or demand level. After that, then we again have our rally, which is a swing high or high buy pressure. Yes, so we have rally, base, rally. Now let's look at the second example of demand zone structure, which is a drop base rally or swing low, demand, swing high. So this is a typical example of drop base rally. As you can see, this particular momentum swing low served as our drop. So this is our drop. Then this particular zone which consolidated was our demand zone, though it wasn't formed on the straight line or straight zones, but typically this served as our demand or base zone. And after that, then we have another rally, which is a up move. So we have drop, base, rally. Yeah, another typical example was also formed here: drop, base, rally. This is where we have our demand zone. Yeah, it happens all the time. Another one was formed here. It's a gap. This is what I discussed in my previous video, that is called volume imbalances, which is normally caused by news that are being released on weekends. So as soon as market opens, then this gap or volume imbalances are being created. So from the top to the bottom is where we have our drop formation. Then throughout this level is our base or demand level. Then after that we have our swing high, which is our rally. Yes, so it happens over and over and over. This is what drop formation. Then the whole of this zone was our base, though price went up before coming down. After that, then we have our rally. Yes, another typical example here: drop, base, rally, drop, base, rally. Yes, on our 5-minute time frame, you also have drop in market structure, base, then rally, drop, base, rally. Yes, so the base represents the demand level. Yeah, so it's like that. Another typical case study was formed here: drop, base, rally. Yeah, so my people, these are the two types of demand zone market structures. Don't forget, the first one is a rally based rally, which is the A. And then the second type of demand zone market structure is drop based rally, which is what downtrend, demand, uptrend. And don't forget, the first type of demand zone market structure is where demand is located at the minor zones. And then the second case study of demand zone market structure is a situation whereby demand is always located at the major levels. In my next video, I will come out with a continuation of supply zone market structures. Yes, so on this note, I would like to sign out here. See you in my next video. I love you all. Bye bye.